So this is quite interesting development and shows you a reason why people should actually be invested in Chinese stocks, at least some parts of the portfolio. So here the news is, and by the way, this was leaked by the same Reuters reporter that was talking about a PCAOB team from the US going to China in order to solve the deal. And this report here now is about the second biggest US pension, California state teachers retirement system is looking to hire Chinese equity specialists in order to make more sense of Chinese equities and possibly investing in them. And the reasons are that they are worried about inflation in the US, about a recession possibly going forward, and also the need for diversification. So meaning they cannot put all of their eggs in just one basket, the US stocks, which is the most famous asset class right now, of course, for them to invest. And so this is quite interesting because this is actually the first time that this is happening. And today I'm actually here in Milan and attending the Crane Shares event at the stock exchange here in Italy. And I personally got to know some of those bankers that are actually, looking to get more information on China, and there isn't much education about it. And actually, that's also why I'm running this channel, to educate people more about what's going on in China and where are investment opportunities. And so, by the way, I posted this one again also in our Patreon community. So there is daily content in that one. If you're joined a $10 tier, make sure to be part of this community. And so while this news today may not have an immediate impact, meaning that fund managers are all going to go into China, it shows the underlying issue here is that you can see in this graph as well, that the black line here is showing the price versus the 10-year average earnings being paid for US equities, versus red line, that's the emerging markets, and the blue line is developed markets without the US. And you can see that people are paying most for the US, and this has been also like this in the past at times, and also the emerging markets are fluctuating. But you can see certainly emerging markets are relatively priced cheap in comparison. And so there always have been those periods where the US is outperforming emerging markets. And by the way, China obviously is making up a large portion of emerging markets. And currently we have been in this time since 2011, where actually the US is relatively outperforming emerging markets. But at some point in time, this trend will also turn again, because right now it seems like everybody is mostly allocating to the US, and that of course can also become a risk in terms of what we've seen today, inflation still being an issue in the US, possibly going into recession, and other topics, maybe even stuff like how will the US government act going forward, how well will be the policies for America, and so you want to have some sort of diversification at least, and have not everything just invested in one asset class or one stock market in particular. And so this is why we possibly see maybe an emerging trend, which could actually mean the bottom here of the US outperforming emerging markets here. And the more people are actually getting educated about the opportunities also in other areas, the more people might be willing to actually pay higher prices, higher valuations for these companies. And that should be good for, let's say, ETFs like Crane Shares, KWEB, but also for single stocks in companies like Alibaba or NIO in the end. So that's it. Quite significant news in my point of view. Will take more time to digest, but I think it may be the start of a trend. Thank you guys for watching, and see you in the next one.